Good afternoon, everybody, and welcome to our webinar today presented by Ness and Krista Gardner. We are talking about upcoming changes to recognizing revenues for not-for-profits today, and I'm just going to do a couple short housekeeping items before I turn it over to Krista. If you have any questions, please submit them in the questions panel of the GoToWebinar pane that you should see on your screen. We do not monitor the chat box. And we will be offering CPE credits today. So we will have 3 polls throughout the presentation today that you will have to participate in. We need an 85% crowd participation in order to move throughout the presentation. And I know that Krista has a ton of information to share with everybody today. So let's make sure that we're wide awake and getting those polls answered so we can move right along. And if you wanted to follow along with her presentation, there is a handout section of the GoToWebinar pane that you can download the PowerPoint presentation that she's going to go through today. So without further ado, I'm going to pass that over to Krista.
All right, thank you, Kaylee, and good afternoon, everyone. Right after, or a little bit after the lunch hour, so hopefully everyone is fully fed and ready to learn lots of stuff about recognizing revenues. Just kind of a heads up on this topic. It's definitely a complex topic. And it's definitely going to be very dependent on every nonprofit's revenue streams, situation. So it's a tough one to present in the sense of examples. So kind of a heads up, what I've done is I'm trying to look at things today at a high level. I've got a couple of examples, but mainly I've selected one example that's going to take us through kind of this whole process. And as you'll see, FASB has designed a 5-step process to go through how to essentially recognize revenues, determine how it needs to be handled, etc. So I've got one example that we're going to walk through the entire process. There is a lot of information on the slides, and it's not all inclusive. It's essentially the main points. There's a lot of caveats to this, and every situation is going to be different. With that said, please submit your questions. I probably won't have a lot of extra time for questions, and because everyone's situation is going to be different, a lot of it's going to be based on what do we do in this scenario, what do we do in this scenario, and because of that, what I'd like to offer to everyone is, and you'll get this as a follow-up email to the webinar today, is everyone's going to have the opportunity for a complimentary 15 to 30-minute call with me if you feel the need to kind of talk about your revenue streams and your situation, just to get a little bit better of an idea of how this really is going to impact your nonprofit. But my goal today is to kind of just give you an idea of what these changes could look like, give you an idea of does it impact your organization, because just from reading the title, we think revenue from contracts with customers, and a lot of nonprofits probably are like, well, we don't really have contracts with customers. You know, we're not selling something or providing a service in that sense. So that probably doesn't apply to me. But what we find is this actually is going to apply to quite a few nonprofits. So again, it's going to be a little complex, but trying to go over the main points. A lot of slides, so bear with me. I tried to set it up in the best way possible to kind of make the most sense and walk through, but please submit those questions. If we don't get to them during the webcast, I'll make sure that I reach out to you afterwards and you'll get that follow-up. Please, reach out if you'd like to set up a call, again, complimentary, to kind of discuss your situation. So with that said, this is FASB ASU 2014-09. which it's hard to believe that this was, all introduced and kind of started in 2014 or 4 years ago, and it's here already and going to be implemented pretty much immediately, starting with this next year. So the one thing that I like to start with is just a polling question to kind of get an idea of who's on the call. And so our first polling question is just whether or not you are familiar with this topic, with this standard at all. So are you very familiar, are you somewhat familiar, or not familiar at all? Just to kind of get an idea of who's on the call. So Kaylee will open that, and if you could answer accordingly.
All right, Krista, looks like everybody was pretty awake this afternoon after their lunch hour. We have 11% very familiar, 62% somewhat familiar, and 27% are not familiar at all. So there's your audience for today.
Okay, great. Thanks, Kaylee. So good. Those 11% of you that are very, very familiar with this, hopefully you'll find, some benefit to kind of walking through an example, some additional information. Those of you that are somewhat familiar, that's fantastic. At least you're not coming in cold. And then those that are not familiar, my goal is that you'll be at least somewhat familiar by the end of today. So we're going to go ahead and jump into what this topic is all about, the overview of this this standard, and this is really a joint project between FASB, or the Financial Accounting Standards Board, which is our U.S. Agency that comes up with our accounting principles, and then IFRS, or International Financial Reporting Standards. So the reason these two bodies kind of came together is they said, hey, revenues are an important number to the users of financial statements. And really that's how a lot of times users are assessing the financial performance and position of an organization. And so they kind of came together and said, let's see what we can do as far as bringing some continuity and consistency. And this standard does affect public entities. So it's all not-for-profits essentially are included in this as well. I'm going to be solely, focusing on the nonprofit piece of this, but this standard does affect other entities as well that are not just not-for-profits. And the objectives kind of then, when they really looked at it, were to remove inconsistencies and weaknesses in the current revenue requirements. We think about it, there hasn't been significant changes to nonprofit revenue recognition in years. And now we're getting lots of changes where we've got financial statement changes happening, revenue recognition happening, and even some other ones coming up in the next couple of years. They also wanted to provide a more robust framework for addressing revenue issues, essentially having some guidance as far as how to handle different types of revenue streams, improving comparability of revenue recognition across entities, industries, jurisdictions, and capital markets, providing more useful information to the users of the financial statements through improved disclosure requirements, and then simplifying the preparation of financial statements by essentially reducing the number of requirements that the entity must refer to. And this is really the two organizations, IFRS and FASB, kind of coming together and putting together one standard that we can kind of focus on. The core principle is the entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. That's the very lengthy official definition here, or core principle of the topic, but really the idea is that we want to be recognizing revenue essentially as an exchange is happening. Again, an exchange is not necessarily going to the store and buying a good and taking it home with you. An exchange can mean a lot more than that, which we'll dig into here in the next couple of slides. So the first topic that we actually have to cover is contributions versus exchange transactions. And contributions we run into all the time in the nonprofit world. And so now it's really kind of taking those contributions and identifying if there are any exchange transactions related to those. So if we look at a contribution is an unconditional transfer of cash or other assets to an entity. I'm a donor, I'm giving $500 to your annual campaign. I am, a donor, and I'm giving maybe prizes for a silent auction for an annual gala that you have. So any kind of transfer of, cash or other assets to that entity. And in those instances, it's voluntary and it's non-reciprocal. In those two examples I gave, it's my choice to give those donations, and I'm not really receiving anything in return. So an actual contribution following this definition is not included under topic 606, or what we're talking about today. Those are true contributions. I will point out that here in 2018, just a few months ago, that there was another accounting standard update that came out for nonprofits. It's topic 958. And this is all about clarifying contributions received and made. And this was essentially in response to this revenue recognition policy coming out in regards to contracts with customers. Then there were questions on how do we, look at contributions and clarifying the scope of contributions. I'm not going to be focusing on this topic at all today just because there's really not time for it. But there is, just to point out, there is some additional information in this update that was just released a couple months ago in regards to contributions. So they updated some of the definitions, the scope, etc., of what contributions really are considered. But the short, simple, sweet definition is essentially that unconditional transfer of cash or other assets, which is voluntary and non-reciprocal. So we jump from a contribution to now what we're focusing on is exchange transactions. So this is a reciprocal transfer between two entities. There's an exchange. There's an exchange of something of value, essentially commensurate value, not incidental value. Like there's a significant value to that. And that's everything that topic 606 is focusing on and what we're talking about today. So it's all of those exchange transactions. There's something that's going between the two entities. There's essentially an expectation there of a benefit or a good or a service that's being provided. So an example of this, which I tried to pick examples that would be, I think, useful to the majority. So I apologize if this example maybe doesn't apply to you, but hopefully it applies or is familiar to the majority of you. So in this example, our nonprofit ABC offers various sponsorship levels for their annual conference. This could be a conference, this could be a gala, any kind of event. And this company XYZ, has chosen to be a gold sponsor for $10,000. The gold sponsor level includes the sponsorship of the dinner reception with the company's name displayed as the backdrop on the main stage, the company's logo on the conference website, visual and verbal stage recognition during general sessions of the conference, booth space and free internet access, which is also offered to non-sponsors at $1,000 per booth, and 5 conference passes, which are also offered to non-sponsors or attendees at $500 per pass. So based on this information, our question that we ask ourselves is the above example a contribution, an exchange transaction, or do we have both? And the answer here is we have both. So there are 2 exchange transactions that are happening in this case, where there's booth space that's being received and conference passes that are being received. So in the fact that company XYZ has chosen to be a gold sponsor for $10,000, they are getting in exchange these 2 items, that booth space and the conference passes. As far as contributions go, the dinner reception sponsor, the logo on the website, and the visual or even verbal stage recognition essentially is incidental. So in this scenario, essentially, it's not a significant value that's being received for being that sponsor. So that piece or those 3 items are essentially considered contributions, but the other 2 pieces are considered exchange transactions based on this definition. So again, you have one kind of transaction, company XYZ, hey, I want to be a gold sponsor of your event for $10,000. And now we have to look at it in 2 pieces. And this is really the first, I'm going to say the first step, but maybe we'll say our planning phase of going through this standard is identifying our revenue streams as an entity. And then in each of those revenue streams or those categories of the revenue that your organization receives, coming up with a determination as to are there exchange transactions included in any of those revenue streams. And that's really the first part of kind of implementing the standard is assessing those revenue streams and identifying the revenue that you're collecting, and then are they true contributions, are they true exchange transactions, or is there a combination of the 2? So Moving forward, I actually have two polling questions in a row. I apologize, but they kind of, feed on each other just to kind of get an idea of what everyone is seeing as far as revenue streams. So the first polling question that I'm going to ask is, does your organization have both contributions and exchange transactions? Yes, you have both, no, just one or the other, or you're unsure. And it's likely that at this point you're unsure because, we're used to essentially taking that sponsorship and calling it a sponsorship and being done with it. But as you can see, we kind of have to assess it and break it apart into individual transactions. So if you could answer that, we'll get the results from Kaylee, and then we'll jump into just a second question about your revenue streams as well to kind of give us an idea of, who's on the call and what areas you might be looking at.
Okay, so the first polling question, all the results came in pretty quickly. So we have 71% yes, 5% no, just contributions, 3% no, just exchange transactions, and 21% are unsure.
Okay, great. Thank you, Kaylee. So then jumping into the next polling question, revenue streams or categories of revenue. Now I'm just talking main revenue streams. We all have our miscellaneous income, but as an organization, do you typically have 1 to 5, 6 to 9, or 10 or more main revenue streams that your organization relies on as far as supporting your organization throughout the year? And this is really dependent on the type of nonprofit that you are.
Alrighty, I'm going to go and close this one as well and share the results with everybody. So we have 54% say they have 1 to 5 revenue streams, 32% have 6 to 9, and 14% have 10 plus.
Okay, great. Thanks, Kaylee. So that's kind of what I expected, a good mix between those first two. There are definitely organizations out there that have 10 plus revenue streams. But mainly we see that 1 to 5 or that 6 to 9. So, and what that truly means is, kind of starting off with the standard is if you've got 1 to 5 revenue streams, you've got 1 to 5 kind of starting points of let's assess those revenue streams. And do you have a revenue stream where, everything that's recorded under that category operates in the same way that you can kind of assess it as one category? Or it could even be that you've got a line item of revenue that, maybe there's some differences and you might have to break it out into more detail to kind of assess the situation. So what we're going to do now is jump into the implementation process. And again, I have one example that we're going to walk through this whole process. It's a lot of slides and it's a lot of information, so just bear with me. The 5-step process that FASB has provided is essentially identifying the contracts with the customer. So this is now after the fact that we've looked at contributions versus exchange transactions. We're now going to identify what they're calling contracts with customers. We're then going to identify performance obligations in the contract, determine the transaction price, allocate the transaction price if there are multiple performance obligations, and then how do we recognize that revenue? So jumping into step 1, identifying contracts with customers. So a contract is an agreement between 2 or more parties that creates enforceable rights and obligations. A contract can be written, oral, or implied. What FASB has defined is that a contract must meet all of the following criteria. There's approval and commitment from the parties. There's identification of the rights of the parties. There's identification of payment terms. The contract has commercial substance, or there's legitimately a situation, a scenario here that's comparable to other nonprofits or other areas that of similar situations essentially. And then the 5th one is it's probable that the entity will be able to collect the amount for the exchange of goods. So those are the 5 items that FASB essentially says must be met to be considered having a contract between 2 or more parties. There can always be contract modifications. I just kind of wanted to throw this in here. This can easily happen throughout the course of time. And a contract modification could be a change in scope or price. Again, it can be in writing, orally, or implied. And you would account for the modification in 3 different ways: a whole new separate contract, termination of the original contract, and then replacing it with this new contract, or essentially a continuation of the original contract. So treating the modification as part of the original contract. So not going to really focus on an example of modifications here, but knowing that, you know, it's legitimate that that happens often, that prices can change, or maybe there's negotiation going into, you know, a second year of a contract, that maybe you would make a change to the scope or price of an original contract, or essentially just extend the original contract. So I wanted to make sure to kind of give that information to you on, you know, different ways it can be handled. So in our example, not-for-profit ABC is a member organization. Members pay $500 annual dues and sign a membership application. That application could be literally sending in an application. Maybe it's an online application. Again, that contract can be written orally or implied. The benefit to the member includes a $5 donation towards the organization's scholarship fund, legislative advocacy services provided during the year, online access to the members-only section of the organization's website, and 4 quarterly publications received via mail, which also can be sold in bookstores and online for $20. So in this case, do we have a contribution, an exchange transaction, or both? So technically not even on step 1, kind of on that planning phase, do we have a contribution, exchange transaction, or both? And in this scenario, we have both. So if on the right-hand side on the blue box, I pulled out that $5 scholarship donation. Essentially, that's a non-refundable donation to the scholarship fund. There's nothing being received by the member. There's no reciprocal receipt or exchange or transaction. So that truly is a $5 contribution. The rest of the items, the legislative advocacy, the website access, and the 4 quarterly journals are all exchange transactions, because those are benefits that the member is receiving in exchange for that $500 annual due. So now we get to actually jump into step 1. So do we have a contract with this customer or this member organization? And we'll walk through the criteria. So the 5 criteria that FASB gave us is the contract approved and are the parties committed. So in this case, like I said, it could be an actual paper contract or annual membership agreement that the organization submits. It could be an online form where they fill out and essentially said, please renew my membership. Or I guess you could even have it where, you know, someone calls in and says, hey, I want to be a member of your organization. Maybe a bill is sent, etc. But at this point, we can determine that the contract in this case is approved and the parties are committed. Are the rights regarding transfer of goods and services identified? Yes. Essentially, we've identified what the member organization is going to get in return. The payment terms, in our specific example, I didn't really give, you know, it's due on XYZ date, but we can essentially assume that there are payment terms identified that, you know, at the beginning of the year when the application is submitted, the $500 is due. Maybe they can be billed quarterly, etc. Does the contract have commercial substance? It does. You know, there's nothing in here that's kind of out of the ordinary. This is kind of a very typical scenario. And is it probable that the entity will be able to collect? I think based on the information that we have, we can't really make that determination. But essentially, nonprofit ABC could, you know, look back at the history of this member if they have been a member for years, and if there hasn't been any issue collecting payment, then essentially they can say, you know, yes, we're good to go. If it's a new member organization, is there, you know, anything that would, you know, concern them about being able to collect the amount that's owed? But in this case, we're going to go ahead and say, you know, this member organization is, you know, is going to pay, and so therefore it's probable that they'll be able to collect. So in this scenario, all 5 criteria have been met. So we now have a contract with the customer. So we've done our planning phase, and now we've done our step 1, where we've identified a contract with a customer. So moving to step 2, we now have to talk about performance obligations. Performance obligations in a contract are essentially a promise with that customer to transfer a good or service. So here's that exchange. Here's what that customer is essentially getting. If there's more than one good or service promise to be transferred, then each one is accounted for separately if it's distinct or a series of distinct goods and services that have the same pattern of transfer. And what that means is essentially if it's distinct, the customer can benefit from the good or service on its own. So in our example that we'll see coming up here, the publications essentially can be used on their own. And the second one is it distinct within the context of the contract, meaning the promise to transfer the good or service is essentially separately identifiable from the others. And what happens is if we determine that something is not distinct on its own, we then bundle them together or essentially combine them until we can get to the idea where we essentially say, okay, this group of performance obligations really can be considered as one. And so I'm just going to jump to the example because it's going to be easier to follow. So how many promises or performance obligations are included in this contract? So we're going to go through the 2 criteria. So the first criteria is, can the customer benefit from the good or service on its own with other readily available resources? Meaning resources that the customer has on its own. It really wouldn't have to go out and purchase something else to use that item or have some other kind of service that you provide to essentially be able to use or access that benefit. So in this case, the 4 quarterly journals, as I had said, essentially they can be used on their own. So those journals are going to come 4 times a year in the mail, and I can open it up and I can read it, and I'm not reliant on really anything else to use that or benefit from that performance obligation or that promise of the contract. The legislative advocacy and the website access, we've really identified as no. So in this scenario, what essentially is being looked at is, can you really use the legislative advocacy on its own? Can you access the website on its own? And this kind of goes hand in hand with essentially thinking about it like, would we be able to get that piece on its own, which is kind of criteria 2. So in this case, you could have legislative advocacy, like maybe you could pay for that on its own, but in this scenario, it's kind of all grouped into one. And so if we jump to criteria 2, we take a look at it and we say, is it separate from other? So we can't really purchase the legislative advocacy on its own, but it is a separate idea, essentially, or a separate promise or performance obligation from the website access. So I can't go to this membership organization and just purchase legislative advocacy. And I can't go to this membership organization and just purchase the website access. I kind of have to have everything all in one, but it is different from the the 2 are different from each other. They essentially could offer this membership benefit with only one of them. They don't have to have the website access and the legislative advocacy. But what FASB is defining the contract as is essentially you have to meet both of these criteria. So although legislative advocacy and website access are separate from each other, they're not necessarily able to be used without other resources or another piece of it. So what happens in this scenario is we essentially bundle those 2 together, and they're kind of looked at as membership benefits. So we take those 2 items and we're going to call them one performance obligation or promise bundled into membership benefits. So then if we go to our next question on this example, to kind of just illustrate this a little bit better, how many performance obligations are there now? So we know what the list of benefits are here. We've got that $5 donation. We we've got the legislative advocacy services, we've got the online access, and we've got the 4 quarterly publications. How many actual performance obligations are there? And in this scenario, there are 5. So we know that the quarterly publications on their own are each essentially, you can almost call them a deliverable or their own performance obligation. Because I, as a non-member, can go and purchase that publication for $20. So each one of those is its own performance obligation. They have to send them the 4 quarterly publications. We then have this other one that we've bundled, and we're saying membership benefits. So we have 5 performance obligations as part of this contract. So the organization is paying $500. $5 of that we know is a contribution to the scholarship fund, and the remaining part is covering 5 essential transactions, exchange transactions, membership benefits, and then the 4 quarterly publications. So now that we've identified the contract and we've identified the performance obligations, or essentially the promises in the contract, then we move to step 3. And step 3 is determining the transaction price. So the transaction price is the amount of consideration or payment to which the entity expects to be entitled in exchange for those performance obligations or those promised goods or those services. One thing to note is you would exclude anything collected on behalf of third parties. So if that $500 included sales tax, you would not include sales tax in any of your calculations. Now, in our example, we're not going to worry about that, but I did want to just include that is, that would be an example of part of essentially the money you'd be receiving. If you have to then pay sales tax, you would not include that, or any other payments that would be collected on behalf of third parties. This would be specific to the revenue that your organization recognizes. So then there's a couple different things that play into determining the transaction price. And there essentially can be a fixed price and a variable price. Some considerations that go into variability are discounts, rebates, refunds, credits. There could be other incentives or penalties. An example of this might be if you have annual members that you say, hey, if you pay before, if you're a June 30 year end, if you pay before, the end of May, or even, before the end of the year, June, you get 5% off or 10% off. So now you have a variable essentially on this price, because we know that membership costs $500, but if we're going to offer a 5% discount, now we have to determine the likelihood of, the organization's paying with a discount. And it could be even the same thing is if there's a structured payment where if they pay after a certain time, there's an additional fee, a late fee, a penalty. In our example, we're not going to include that, but it is something that you'll have to take into consideration based on what your revenue streams are, what the payment structure is, etc. And essentially what you have to do here is decide how to take into consideration that variable amount. And there's 2 ways that they describe, and that's doing a weighted average. So think about if you have, in our example, we've got memberships, and say we've got 1,000 members. Well, now we might have to look back at historical trends and see, how many of our members pay early and get that 5% discount. Or if it is an instance where there's a late fee or a penalty, how many of our members essentially, have paid late and had that additional penalty that they've had to pay. And then we can kind of essentially do a weighted average, and that's how you then come up with what that, that variable cost would be. The other way to do it is they're calling it a most likely amount, or if there are 2 outcomes. So in this situation, if we had membership revenue and we have members, and maybe you don't have a lot, you don't have 1,000, maybe you have 50 members, could you do a most likely scenario where you go down through and say, okay, is this member most likely to pay the discount or pay the regular price? And then do that for all of your members. So there's 2 different ways that you can handle it, making sure that in any way where you're considering estimates or these variable considerations, that your thought process and rationale is documented. And essentially you've got kind of that backup to help you with coming up with that. And then you want to make sure that it's always handled the same way from year to year, because if you would change it, you then essentially have a change in estimate, which you would have, anytime you would change any kind of estimate, you'd have to disclose that. So again, I'm just brushing lightly on that topic as far as, not digging down too deep, but something to think about. There could be variables that go into the pricing. Other items that might need to be taken into consideration would be any financing components, time value of money, if payments are made over a long term, if there are any non-cash considerations that essentially are being are a part of this contract, and then if there would be any other dealings with that customer that essentially you have a payable to that customer. So there might be additional transactions or relationships or history or other exchange transactions that need to be taken into consideration with a specific customer, as opposed to that one revenue stream on its own. So again, I think in a lot of cases we're going to be more in that fixed pricing consideration, but just to kind of throw it out there, there could be variables. So again, it's going to be very gray in trying to apply how the situation applies to you and how it all kind of works out based on those revenue streams that you have. But moving forward on the transaction price, so in our situation, what is our transaction price? We know the member is paying $500, but what is our transaction price related to our contract? And our transaction price is our $500 of annual dues less our $5 contribution, because we know that $5 contribution is being handled completely separate as an actual contribution. And so therefore our transaction price is $495 for this contract related to exchange transactions and the performance obligations that essentially are being exchanged. So we now have our transaction price, we have our exchanges, we know that we've got a contract, so then we go to step 4. How do we now allocate that transaction price across the performance obligations in the contract? So if there's more than one performance obligation, which we have in our case, we allocate the transaction price amongst each performance obligation, essentially with consideration as far as how the entity expects to be entitled for payment of those benefits, or how those benefits are going to be satisfied. And so a standalone price for each performance obligation should be determined. A standalone price is essentially the price at which an entity would sell a promised good or service separately to a customer. If a price is not observable, so in our instance, we have the journals, the 4 quarterly journals or publications that are $20, and I can buy them at the bookstore as a non-member for $20. That's an observable, if I can say the word, observable price, and we can easily identify that. But in all cases, essentially, we're not going to have that, like in our membership benefits. So in the membership benefits, we've bundled those 2 items, the legal advocacy and the website access, and essentially we don't sell that membership benefit to other customers. So now we have to estimate it. And there's a couple approaches to how you estimate it, essentially 3. The first one is the adjusted market approach. So we go out to the market, like nonprofits or like services, and estimate what the price is that the customer would be willing to pay. And essentially this is where we can look at, we're going to call them competitors. I know we don't think about that a lot in the nonprofit world, but look at other similar situations or similar benefits and goods to see if we can come up with a price that the customer would be willing to pay. The second is expected cost plus a margin approach. I don't see this one probably being used a lot. Again, we haven't started implementing this, but kind of just a guess. I don't think this will be used as much, but essentially forecasting the expected costs and then adding an appropriate margin. So this is really just going to be based on kind of future forecasts and coming up with a margin of 5% added, time values, money, kind of taking into consideration those concepts. And then the third one, which honestly is the easiest, but you can't always use it, is called the residual approach. So the residual approach essentially means let's take what we know and then what's left. So we take the total transaction price less the observable standalone selling prices, and whatever's left, we then apply to those performance obligations. But you can only use this approach if the selling prices vary significantly and if the selling price is uncertain, meaning that, like our membership benefits in this example, if we go out to the market and we're trying to research, similar situations, similar organizations, similar benefits, and it's just all over the place, and we really can't come up with a good price. There's no way that we can, come up with a good estimate. Then essentially you can use the residual approach. But in most cases, I think the adjusted market approach is probably the first step, because we really need to say, okay, can we go out and can we find a like price? Can we identify what the customer is going to be willing to pay? And then essentially go to the residual approach if it's just way across the board and we can't really identify a like item or a like service. So that's how we essentially come up with an estimate, again, if our price is not observable, if there's not a price tag related to it. So in our case, we have this situation because we've got our publications that are $20 a piece, and then everything else we're just calling membership benefits that we don't pay for, or we don't sell. So what happens then is we create these standalone selling prices for all of our performance obligations. And remember, if we're not using the residual approach, we're not taking into consideration our transaction price. We're just coming up with prices for the individual performance obligations, which could exceed essentially our transaction price or the promised condition of the contract. So then we would have to allocate discounts across the performance obligations. And we'll see this in the example here in our upcoming slide. But just to kind of go through how we would allocate discounts is we would allocate them to specific performance obligations or proportionally across the performance obligations. We could only allocate specifically to one if there is evidence that, it truly is related to that one performance obligation, or based on regular sales, a discount would be received on, that performance obligation. If a bundle of services or goods would regularly be priced at a discount. So we have to take that into consideration. We look at our performance obligations, whatever discount we now have, is there one or two or however many that truly are related to that discount, or do we have to proportionally kind of allocate it across all of them? And I think in a lot of cases, we'll see it will be proportionally allocated amongst all of them. So in our example, coming back to here, what is our standalone price for our performance obligations? So remember, we've got 5 performance obligations. We've got our membership benefits and our 4 quarterly publications. Our 4 quarterly publications, as I have said, have an observable price. I can purchase them for $20, but our membership benefits need to be estimated because we don't sell those. We don't sell them on their own, and therefore we don't have an observable price. So we need to estimate it. In this scenario, this nonprofit has determined that based on using the adjusted market assessment approach, that they have found a similar nonprofit providing similar membership benefits, or they've determined that the customer would be likely to pay $470 for similar services. So in this case, we now have an estimate of $470 for our bundled membership benefits. And in this case, we really can't use the residual method because they're not regularly selling those membership benefits. And we were able to identify, based on other factors, what someone would be willing to pay. So now we've got all of our performance obligations and we've got our standalone prices. So our membership benefits we have now determined are estimated at $470, and we have our 4 publications with observable prices of $20 each. So our total is now $550, but we know our transaction price is only $495 because the member paid $500. $5 is going to the scholarship fund. So our transaction price is $495. We now have to apply a discount amongst our performance obligations. Excuse me. So how the recommendation is, because we essentially, there's nothing out there that says if you buy 3 publications, you get, 1 discounted. There's nothing out there that, it would point to us saying that, okay, this whole discount should go directly to the membership benefits. So we're going to allocate the transaction price across the performance obligations based on their standalone price percentages. So you can see here, $470 is 84%, and each of the publications are 4%, which then equal the 100%. So that's how we would allocate the discount. So when we allocate the discount, essentially we come up with these new prices. Now, I know you're looking at this and saying, well, Krista, $20 discounted is not $20. So $20 discounted at 4% is $19.80. So in this situation, I just kept it rounded at $20. So what kind of is humorous, I guess, for me with this example is technically it's residual value because we've taken the $495 minus the 4 quarterly publications of $20 each and come down to what's left of $415. But technically, we did it based on an allocation. It's just the fact that the membership benefits were so high, 84% of the price, that that 4% is 20 cents, essentially, is pennies. And so therefore, I just kept it at $20. So again, we allocated the price amongst the performance obligations based on their percentages. It's just in this transaction, it ends up being we keep the publications at $20 and the membership benefits are now at $415, which totals our transaction price of $495. So we've identified the performance obligations. We've come up with pricing. We've come up with pricing by either having the observable inputs or we've estimated them. And in this case, we estimated it based on what's going on in the market. How, we determined, this nonprofit determined that someone would be willing to pay $470 for that bundled membership benefits. And then essentially after coming up with the prices, our total was $550. We know the transaction price was $495. So then we have to discount it to essentially get to that transaction price. This example is a very simple one, but I think hopefully it's showing you kind of the process as far as where we go from here. So now we are at the last step. So step number 5, how do we recognize the revenue? So we've gone through 4 steps to get to this point, and now it's kind of the, what we all want to know is, okay, so when do we recognize this revenue? And the revenue should be recognized when the performance obligations are satisfied. So when those exchanges in the contract take place. So maybe it's the customer obtains control of a good or service. And really this can take place over time or at a point in time. So the easiest one is going to be a point in time. So if we think about our example, when I mail out the quarter 1 journal to my member, essentially when I put it in the mail, that revenue can be recognized because now that journal is on the way to that member and it's theirs. But over time, it's going to apply to our example with our membership benefits because they now have a year of access to our website and legal advocacy. So that revenue needs to be recognized over time. And essentially, we do that by consistently applying some kind of method of measurement. So if we look at how that might be measured, the criteria for recognizing revenue over time is the customer is kind of simultaneously receiving or consuming benefits as we're providing them. The customer the asset continues to be created or is enhanced by the control of the customer. So in this case, each time this member accesses our website, it's enhancing their benefit. or creating additional opportunities that they're taking advantage of. And then the entity's performance does not create an asset with an alternative use, meaning that they can't just go, the member can't go and essentially replace the website access with something else. So we know pretty much for sure that we're basing this off of 1 year of membership access to the website, which includes legal advocacy. There's no chance of that changing, really. And there's a lot of methods that can be used to recognize the revenue over time. Again, this is going to be based on your situation. This is going to be based on, are we talking an annual membership? Are we talking a smaller period of time? But it might be based on outputs, so results or milestones, or it could be based on inputs, resources consumed. So it might be that you have an estimate of how often the members access the website. You might have that information where you can average that. You might also know, how many times certain members are reaching out for the legal advocacy. Or it might just be that you reasonably estimate it and kind of recognize it equally over the period of time. The thing to kind of point out here is that you can't just say, all right, we're going to equally recognize it over the 12 months. There needs to be a little bit more to that thought process and some substantiation as far as, based on history or, what we know or any reports or access, etc., that those benefits are received by the customer pretty evenly throughout the year. Depending on your like industry your nonprofit's in, you might be very cyclical, where you've got a certain time of the year where there's a lot more that's going on. And so maybe that is what goes into play as far as how much of the revenue you're recognizing during, quarter 3. So although I think a lot of people want to be like, well, let's just spread it out over 12 months, there needs to be a little bit more thought process to that. And the reason I also bring that up is we're going to get to the fact that there are some disclosure requirements in regards to some of this. And so that the estimation process will have to essentially be documented and formalized, at least internally, but then in some cases externally in your accounting methods of your financial statements. So then as far as revenue at a point in time, this is an easier one to kind of identify because, again, those publications, I'm putting them in the mail, I'm sending them to the member. But some questions that you can ask, is there a present right to payment for the asset? Who has the legal title of the asset? Has the physical possession been transferred? Any risks or rewards related to the ownership of that good? Has that been transferred? Has there been an acceptance of the asset by the customer? So those are questions to kind of ask yourself as far as, when that point in time occurs. But again, I think this one is going to be a little bit more more easy to identify as far as, in our example of that publication, when we go ahead and mail it, we're going to recognize that revenue because we have now satisfied that exchange transaction of the contract. So now to our example, when do we recognize our revenue? So remember, we've got our 5 performance obligations, we've got our membership benefits throughout the year, and our 4 quarterly publications. So our membership benefits are for the year. They're over time. It's a 1-year membership. So we're going to recognize that revenue over time. So essentially, this is where we have to determine does the member use the services equally throughout the year that we can, monthly record a 12th of it? Or is it really that, there's a couple months out of the year where it's used a lot more, maybe based on if we talked about legal advocacy, maybe there's, legislative things, et cetera, that you have to take into consideration. But that's where we would determine how to best estimate those membership benefits. And again, this could be the same for all members that pay $500 for annual dues, or you may need to break it into categories. You might have to take a look at your members and essentially say, 50% of them use it equally throughout the year. The other 50%, it's more of a, quarterly basis that they would use it, and that's how you would recognize it. And then the publications would all be recognized at the point in time. So if you send out your publications quarterly, say July 1, October 1, January 1, etc., that, maybe when they get mailed out, that is when you recognize that revenue at that point in time. So we made it through the 5 steps. As I promised, there's a lot of information, and literally we're at 55 minutes, and we used one example through all 5 of them. Again, there are so many situations where it's just going to be dependent on your customer base, your revenue streams, your transactions, etc. But at least to kind of walk through the thought process of what an exchange transaction is and how to essentially apply this 5-step process. As I noted a few slides ago, there are some additional disclosure requirements. The goal of those are really to provide the reader of the statements with more information about the nature, amount, timing, and any uncertainties in regards to revenues and cash flows. Again, the whole purpose is the fact that revenue is so important to understanding how an organization is doing. And to be honest, it's usually one of the first things that a reader of a financial statement is taking a look at. And so that's the goal, is to really help the readers, kind of more understand the revenues from your organization. Some examples of the disclosures that you might start to see are revenue categories. So really taking your revenues and identifying, disaggregating them into different revenue categories as far as, how the revenue is received, what's affected by economic factors, what revenue streams are related to contracts. And that could be qualitative and quantitative information in regards to those contracts, opening and closing balances, amount of revenue recognized from contracts, any significant contract changes. And then as far as those remaining performance obligations, I like to read this and think about it that most instances will all happen within one fiscal year, but we know life isn't that easy. And so there's going to be situations where a performance obligation there could go over fiscal years. And so therefore, if there's a transaction price that's been allocated to performance obligations that are still outstanding, and essentially how revenue is being recognized in relation to those performance obligations, those contracts, and how that all kind of comes together and is presented in your statements, what those revenue streams are, and then how they relate to essentially exchange transactions as opposed to just contributions. So some takeaways, knowing that I've got 2 minutes to go here, just to kind of remind everyone, the goal of this is to really improve our understanding of revenue, but specifically of this topic, accounting for contracts with customers. Provide a robust framework for addressing revenue issues as they arrive. So again, this is allowing kind of 2 entities to come together and put together one standard, a very large standard of, okay, here's a revenue situation, how do we recognize it? Increasing our comparability across different industries and markets, and then requiring better disclosures. So again, more information as far as what are these revenues, and how they relate to if there are exchange transactions or contracts. Who's affected? All not-for-profit entities are affected, and the periods affected are those beginning after December 15th, 2018. So essentially, if you're a December 31 year end, your December 31, 2019, so we're getting ready to start our 2019 year here, this is the first year that this becomes applicable to you. So your January 1 through December 31, 2019 statements, or if you're a June 30 fiscal year end, you get a little bit of extra time. So your June 30, 2020 year end, or your beginning year, July 1, 2019, is the first year that this would become applicable for your organization. Again, first we need to take a look at contributions versus exchange transactions, and then we went through our 5-step implementation process, identifying the contracts, identifying the promises or performance obligations in the contracts, determining the transaction price, allocating it across multiple performance obligations, and then when do we actually recognize the revenue. So as I thought would happen is we are at 3 o'clock, and I do know that there were some questions submitted along the way here. Again, I promise you that I will reach out to each of you on those specific questions. The presentation, I know the handout is attached, and you can download that. The presentation is also available on our website, and there will be a follow-up email that will come out in regards to the presentation today. Again, because of how complex this is, and it's applicable to different situations, I'd be more than happy to do a 15 to 30-minute complimentary phone call with anyone to kind of talk a little bit more in detail about what what these truly mean and how it could apply to your organization. So sorry that I ran out of time, but I kind of knew I would. Again, please let me know if you have any questions, and I think that's it. Kaylee, is there anything else?
I don't think there is. If you have any questions, feel free to email Krista. Her email is listed up in the top left-hand corner, and she will be happy to assist you. If you have any other questions, please submit them in the survey at the end, and there is a space to let us know how we did there. So with that, I think we can go ahead and end the presentation, Krista.
All right, thanks everyone. Have a great day.